Welcome to your journey into the stock market. Today, we're unlocking the secrets to start investing with just $100. You don't need to be wealthy to build wealth. The stock market is more accessible than ever in 2025. With the right knowledge, anyone can start investing and grow their money over time. This video is your step-by-step guide to understanding the stock market. We'll cover how to begin with a small budget and make smart choices. By the end, you'll feel confident to take your first steps as an investor. Let's start with the basics of what the stock market actually is. The stock market is a place where people buy and sell shares of companies. When you buy a share, you own a tiny piece of that company. If the company does well, the value of your share can go up. But if the company struggles, the value might go down. That's the core idea. But there's so much more to learn. Apps and platforms let you invest with just a few dollars. You can even buy fractional shares, which means you don't need to buy a whole share. For example, if a share costs $1,000, you can buy a fraction for $100. This opens the door for beginners with small budgets. But before you jump in, you need a plan. Investing without a strategy is like driving without a map. You might get somewhere, but it's risky and stressful. Let's build a simple plan to start with $100. First, set clear goals for your money. Are you saving for a car, a house, or maybe retirement? Your goals will shape how you invest. For short-term goals, you might want safer investments. For long-term goals, you can take more risks. Stocks are great for long-term growth. Over time, the stock market tends to go up. Since 1926, the S&P 500 has averaged about 10% annual returns. That's a solid track record for building wealth. But returns aren't guaranteed, and there are ups and downs. That's why patience is key. Next, you need to choose a platform to invest. In 2025, there are many beginner-friendly apps. Some popular ones include Robinhood, Fidelity, and Webull. These platforms offer low or no fees for trading. Look for an app with a simple interface and good customer support. Make sure it's regulated by authorities like the Securities and Exchange Commission. Safety matters when you're trusting a platform with your money. Once you pick a platform, open an account. You'll need to provide some personal information. This includes your name, address, and social security number. It usually takes a few minutes to set up. Then, deposit your $100 to get started. Now comes the fun part, choosing what to invest in. With $100, you have a few smart options. One of the best choices for beginners is an exchange-traded fund, or ETF. An ETF is like a basket of stocks. It holds shares from many companies, spreading out your risk. For example, an S&P 500 ETF includes the top 500 companies in the US. Think Apple, Microsoft, and Amazon all in one package. ETFs are affordable and reduce the risk of picking a single stock. You can buy a fractional share of an ETF with your $100. Another option is to invest in individual stocks. This is riskier because you're betting on one company. But it can be exciting if you believe in the company's future. Choose companies you know and understand. Maybe it's a brand you use every day, like Starbucks or Nike. Research their financial health before investing. Look at their earnings, debt, and growth potential. You can find this info on free websites like Yahoo Finance. Don't just follow trends or hot tips from social media. Do your own homework to make informed decisions. In 2025, the market has some unique trends. Artificial intelligence is a big driver of growth. Companies like Nvidia and Microsoft are leading the way. Clean energy is another hot sector. Look for ETFs that focus on solar, wind, or electric vehicles. Healthcare is also strong, especially biotech firms. But trends can be risky if they're overhyped. Balance trendy picks with stable, established companies. Diversification is one of the biggest secrets to success. Don't put all your money into one stock or sector. With $100, an ETF is a great way to diversify. If you buy individual stocks, pick a few from different industries. This way, if one sector struggles, others might do well. Now let's talk about risk management. The stock market can be a roller coaster. In 2025, experts predict volatility. Economic policies and global events can shake things up. Don't panic when prices drop. Dips are normal and often temporary. Only invest money you can afford to leave alone for years. Never use your emergency fund or rent money. A good rule is to have 3 to 6 months of expenses saved first. That way you won't be forced to sell at a bad time. Another secret is to keep learning. The more you know, the better your decisions. Read books like The Intelligent Investor by Benjamin Graham. Follow trusted financial news sources. Avoid scams and hype on social media. If someone promises quick riches, run the other way. Investing is about slow, steady growth. Let's talk about compounding, the magic of investing. Compounding is when your earnings generate more earnings. Imagine you invest $100 at 10% a year. After 1 year, you have $110. The next year, you earn 10% on $110. That's $11, not 10. Over decades, this adds up dramatically. If you invest $100 a month for 30 years at 10%, you could have over $200,000. That's the power of starting small and staying consistent. To make compounding work, reinvest your dividends. Dividends are payments some companies give to shareholders. Instead of cashing them out, use them to buy more shares. This grows your investment faster. Many ETFs and stocks offer dividend reinvestment plans. Set it up automatically to stay hands-off. Consistency is another secret to success. Try to invest a little every month, even if it's just $10. This is called dollar-cost averaging. It means you buy more shares when prices are low and fewer when prices are high. Over time, this lowers your average cost per share. It's a simple way to avoid trying to time the market. Speaking of timing, don't try to predict market highs and lows. Even experts can't do it reliably. Focus on time in the market, not timing the market. The longer you stay invested, the more likely you'll see growth. Let's look at taxes because they affect your return. When you sell stocks for a profit, you may owe capital gains tax. If you hold a stock for more than a year, the tax rate is lower. This is called long-term capital gains. In 2025, these rates range from 0 to 20%, depending on your income. Short-term gains are taxed like regular income, which can be higher. Holding investments longer can save you money. Consider a Roth IRA if you're starting small. It's a retirement account where your earnings grow tax-free. You can contribute up to $7,000 a year in 2025. Your $100 is a great start. Withdrawals in retirement are tax-free, which is a huge perk. Check if you qualify based on your income. Now let's address some common mistakes. One big error is chasing hot stocks. Just because a stock is soaring doesn't mean it's a good buy. Often, it's already overpriced by the time you hear about it. Another mistake is selling too soon. If a stock dips, don't panic and sell at a loss. Good companies often recover over time. On the flip side, don't hold on to a bad investment forever. If a company's fundamentals are weak, it might be time to let go. Emotions can sabotage your success. Stay calm and stick to your plan. In 2025, the economy faces some challenges. Interest rates might stay high, slowing growth. Trade policies could create uncertainty. But challenges also create opportunities. Value stocks, which are undervalued, might shine. Sectors like utilities and consumer staples tend to be stable. Keep an eye on these for balance in your portfolio. Let's talk about tracking your investments. Check your portfolio once a month, not every day. Daily swings can stress you out for no reason. Focus on the big picture like your overall growth. Use your platform's tools to see how your investments are doing. Adjust your strategy as you learn more. Maybe you'll add more money or try new sectors. Investing is a journey, not a race. Let's explore some advanced tips as you grow. Consider dividend stocks for steady income. Companies like Coca-Cola and Johnson & Johnson are known for reliable dividends. These can add up over time. Another idea is to look at international stocks. Markets in Europe and Asia can offer growth. An international ETF is an easy way to start. Just be aware of currency risk. You might also explore robo-advisors. These are automated platforms that manage your investments. They're great if you want a hands-off approach. Popular robo-advisors include Betterment and Wealthfront. They charge small fees but save you time. As you gain confidence, keep experimenting. Try new strategies with small amounts of money. The stock market rewards those who stay curious. Let's wrap up with a real-world example. Imagine you invest your $100 in an S&P 500 ETF. You set up a plan to add $10 a month. Assuming an average return of 8%, let's see what happens. After 10 years, your investment could grow to about $2,000. After 20 years, it could be over $6,000. And after 30 years, it might reach nearly $20,000. That's from a small start and steady contributions. This shows how powerful investing can be. You don't need to be rich to make it work. You just need to start and stay committed. The stock market isn't a get-rich-quick scheme. It's a tool for building wealth over time. With $100, you're taking the first step. Keep learning, stay patient, and watch your money grow. Thank you for joining me today. Now it's your turn to unlock the stock market secrets. Take that $100 and start your journey. The future is yours to build. Good luck and happy investing.